Assalamu alaikum friends, welcome to lecture 18 of SBR IAS 33, earnings per share. Here we are going to go through the scoop, the basic calculation, bonus issue, right issue, diluted EPS and assessing EPS as performance measure. Before I start this topic, you need to know that in EPS you have to learn various formula which will not be given to you in the exam, right? You have to memorize it. This is basically EPS. Most of it are your the knowledge carried forward from your financial reporting. Okay, that means it will be assumed that in SBR you will be knowing it. But still, I thought of revisiting it again, the basic EPS, the diluted EPS once more. Okay, for SBR, for the point of SBR, we are more focused on the last part, that is assessing EPS as a performance measure. But even then you have to know the formula. When there's a bonus issue, how the formula will change. When there's a right issue, how it will change. EPS, what is diluted EPS and basic EPS. You need to go through this again. Okay, so the scope is earnings per share is only applied to listed entities. If you are a non-listed, IAS 33 is not applicable to you. Okay. Now, basic calculation. So this is the basic calculation. This is the formula that you need to remember. That is profit divided by weighted average of ordinary shares. Okay. Or you can say it's a basic EPS. One is basic EPS, one is diluted EPS. Okay. Diluted EPS will always be less than basic EPS. Remember this. Okay. We'll go through diluted later on. So, if an entity prepares consolidated financial statement, okay, then for the EPS formula you have to use consolidated profit, but only which goes to the parent. Okay, so that means, but the profit that you are given in consolidated statements are total, both for the NCI and the parent. So you have to take out the profit that is attributable to the NCI. Okay, so total consolidated profit minus profit that goes to NCI. Okay, then for the weighted average number of shares, okay, you have to see during the year when are you issuing those shares, right? It depends on the timing of the shares that you're issuing. So now let us do a question on this basic EPS before we move on to bonus and right issue. Illustration 1. So we are in the basic EPS. You have been given the profit and the ordinary shares for the 2 years, and you have issued some 200,000 shares on 1st of July 2008. Okay, you have to calculate basic EPS. So how do you do this? For 2007, okay, for 2007 it is pretty easy because there has been no issue of share during that year. Okay, so it is the profit which is 460 and divide by 800,000. So it is 460,000 which is the profit, divide by shares, which will be 57.5 cents. Okay, coming to 2008. In 2008 you had issue of share, right? How much was it? 200,000. You have issued 200. So that means this, see here, this 1 million they have given the full amount after this 200 share has been issued. This was issued on 1st of July. So what they did, they have added this 200 with this 800,000 and then they show this 1 million. All right, but you see they have issued this in 1st of July for 6 months. So that means this 800,000 is only for 6 months and this 200,000 is also for 6 months. You see, sorry, not this 200,000. When you take this, you have to take this 1 million for 6 months. Okay, so it will be like this. If you calculate the share, 800,000 into 6. After that you have issued 200. So if you add that 200 with 800,000, it will be 1 million. Okay, into 6/12. For the remaining 6 months, you have this one. So when you add it, it will be 400,000 shares, 500,000 shares. Add both, it will be 900,000 shares. You get it? Okay. So it will be, so this is the one, and your profit will not change. It will remain 550. Only your shares will change. So it will be 550,000 divided by 900,000, the new shares, the weighted average, which will be equal to 61.1 cent. You see, this is how you calculate basic EPS. Now we are moving on to the bonus issue. So now for bonus issue, if an entity makes a bonus issue, you need to remember that only your share capital increases. It does not have an impact on your earnings. Why? Because you're not receiving any cash. This means bonus issue will reduce your EPS. Okay. You need to calculate one fraction which is known as bonus fraction. Okay. So what do? You multiply the number of shares outstanding before the bonus by the bonus fraction. This is the bonus fraction. You need to memorize this formula. It will not be given to you in the exam. It is number of shares after bonus issue divided by number of shares before the bonus issue. We'll do questions. We'll do a question now on this bonus issue. So EPS for the comparative period must be restated. How do you do that? The easiest way is you multiply the EPS of the previous year's financial statement by the inverse of the bonus fraction. Okay, let's do a question on bonus issue before we move on to right issue. Illustration 2. So here you have been given a bonus issue of 1 new share for every 5 existing shares. Okay, the profit are same, but here it changed. Here it is 1 million and 1.2 million, right? And you have been given. So part A, calculate basic EPS. B, with the bonus issue, right? Calculate the prior year comparative EPS. So now, first let us do the basic EPS. I'm sure you will be able to do the basic EPS, right? For 2007, it will not change because bonus issue has been made for 2008 only. So only 2008 figure you need to change. Okay. If you take, it will be for 2007, right? They have asked for 31st December 2008. For this year's, they are asking the basic EPS. So for 2007, you don't have to calculate. Okay. So if you go by basic EPS, it will be this. First, yeah. So it is 550,000 divided by, you have to find the number of ordinary share, right? For this, there's a working that is required. Okay. You have to calculate the weighted average number of share. How do you do that? See, this 1 million. Okay. You will be having it for first 6 months. That means from 1st of Jan till 30th June 2008. You will be having this 1 million. So this 1 million you have to take for 6 months. Now, that's not enough. You have made a bonus fraction. You have to multiply it with a bonus fraction. It was 1 for 5 bonus issue. What is it? 1 new share for every 5 existing. So you need to multiply this with 1 for every 5. That means it will be 6th over 5. With 5, you are adding 1 more. You understanding? 1 for every 5. So if you take it in terms of fraction, it will be 6 over 5. After the bonus, okay? 1 plus 5, 6. And then divide by 5. That means a shareholder who had 5 shares before bonus issue now will have 6 shares after the bonus issue. You understanding? So this is after, because the bonus fraction means after bonus it is 6. Before bonus it is 5. That's why the bonus fraction is 6 into 5. You have to multiply it with 6 into 5. You understanding? That's why I'm multiplying here by 6 divided by 5. After bonus it is 6, before bonus it is 5. 1 for every 5. So then you get 600,000. Now, what about this? This also you have to take only for 6 months. 1.2, 6 divided by 12, which is again 600,000. So you see both are 600, 600,000. It adds up to coincidentally the same number, 1.2 million. So here 1.2 million is the weighted average. Now, what do you get is 45.8 C. This is the answer. Now we are moving on to part B. Part A is done. Basic EPS we have done. Calculate the prior year comparative EPS. Part B. Okay. What was the EPS? You need to now find 31st December EPS. 31st December 2007 EPS. You first need to find this. It will be 460 divided by 1 million. Isn't it? 460,000 divided by 1 million, which will be equal to 46 cents. Now, you have to multiply this with the inverse of the bonus fraction. You see? So you multiply this 46 cents by, what is the bonus fraction? 6 over 5. Inverse will be 5 over 6, which will be 38.3. Why do you do this? Why do you multiply it with the bonus fraction? So that you can compare. You can compare this with this. You see? Sorry, you compare this. What is it? 45.8. You see, it was 45.8 after bonus in 2008. But when you want to compare it with 2007, bonus was not there. So you have to take the impact of that bonus also there. You understand? That's why you are multiplying it with the inverse of this one. So now it is 38.3. Because see, I will show you why we did that. You need to understand it logically. Okay? 2008 with the bonus, it was 45.8 C. Okay, 2007. Once you have adjusted for bonus, it is 38.3 C. You see, it increased from 2007 to 2008, which should be the case because that's why you are doing the bonus issue. Okay, but if you see here for B, without taking the bonus, if you have just taken 460 divided by 1 million, it was 46. See, it was more than this. So the comparison was not like. You're not comparing like with like. Here you didn't take the impact of bonus. But in 2008, there was a bonus. So comparing 2007 and 8 becomes very difficult. They are not similar now. You understand? That's why. But you don't need to understand the logical reason. I'm just explaining you. Just understand that if a bonus is there, you have to change the previous year's EPS also by multiplying it with the inverse of bonus fraction. And now let us go to the right issue. We are done with the bonus issue. Now we are moving on to the right issues. So for right issue is basically made at less than the full market price. So you can see this have the characteristics of both full market price and bonus issue. You have already seen easiest way to deal with bonus is to calculate the bonus fraction and apply it to the shares outstanding before the bonus issue. Same way we have to do this for the right issue. Before the right issue, we multiply it with the bonus fraction. Bonus fraction for right issue is a little different. It is this: market price per share before right issue divide by theoretical market price per share after the right issue. You need to memorize it because we are going to do question after this. EPS the same way we have done for the right bonus issue. For comparative, that means for the previous year EPS also we have to restate. How? Multiply it with the inverse of the bonus fraction. Now let us do a question on right issue before we go to diluted EPS. Illustration 3, right issues. So in the right issues, A, we have to calculate basic EPS, and B, we have to calculate the prior year comparative EPS figure. Okay. Now, an entity issued one new share for every two existing share at 1.5, and the pre-issue market price was 3 per share. So, how do you calculate the basic EPS? you have to first calculate the weighted average number of share. This will remain same. Nothing will happen to the profit, but your shares will change, right? So first you need to calculate for A, weighted average number of shares. Okay. Now, when was this share issue? It was on 1st of July. So that means for 6 months you'll be having this and this for the remaining 6 months. But you have a working with this 800,000. Wait, you have to multiply it with the bonus fraction. You see 800,000 into 6/12 into the bonus fraction. You have to calculate that bonus fraction. Okay, so we'll keep some space and we'll go to working 2. This is bonus fraction. So the bonus fraction is market price before the right issue divided by theoretical market price after the right issue. So before the issue, the market price was 3, and after the issue, okay, how much it will be? You have to calculate the theoretical market price, by the way. You will not be given it directly, okay? But market price before the share issue was $3. Okay, it is 3 divided by theoretical market price. For that, we need to go to working 3. You need to find theoretical market price. We'll keep some space and we'll go to working 3. It is theoretical, okay? Theoretical share price after the right issue. So this is how you find theoretical share price, okay? Understand this. You always need to remember this whenever you are given right issue. You start with number of shares, okay? Then price per share, and market capitalization. Okay, so first before right issue, and right issue. Before right issue, there were 800,000 shares. Okay, after right issue, the right issue is how much? They told 1 for every 2 existing share. That means 800 divided by 2. 1 for every 2 shares. So that means for 800 there'll be 400,000. 400,000 right issue. Every 1 for 2. So sorry, for 1 for every 2. Sorry, it's the other way around. 1 for every 2. Right? So now the total is 1.2 million. What about the price? This was 3. Okay, and the right issue price was 1.5. It will be less than the full price. You see, it's 1.5 here. So it's 1.5. So you just multiply the price per share with the number of shares. This will be 2.4 million. 1.5 into 400,000 will be 600,000. If you add up, it adds up to 3 million. Okay, and theoretical market price will be 3 divided by 1.2 million. So 3 million divided by 1.2 million. It will be equal to 2.5. So you see, this is theoretical market price 2.5. We'll take this 2.5 here to find the bonus fraction. Okay, Bonus fraction will be this, right? 3 divided by 2.5. This is the bonus fraction. So this we take here and multiply it with this. 3 divided by 2.50. And hence we are getting the number of share 480,000. For the remaining 6 months, this 1.2 million, you have nothing to do. You can just take the 6 months. It's just 1 million into 6 over 12, which is 600,000. So it will be 1,080,000. Now you have to find the EPS. So EPS will be profit. Profit is 550,000 for 2008. And now you have got this share. Put it here. The weighted average number of share, which will be equal to 50.9C. This is your EPS. Okay. Now we are moving on to part B. Part B is calculate the prior year comparative EPS. Okay. For that you need to calculate the prior year EPS first, which will be simply this divided by this, 460 divided by 800,000. So here it will be 57.5 C, right? Now you need to restate this. How do you restate it? You multiply this with the inverse of the bonus fraction. So inverse will be 2.5 divided by 3, which will be 47.9 C. Okay, that's it. Now we'll be moving on to the diluted EPS. Diluted EPS. Now you need to know what is diluted EPS. All this while we have been doing basic EPS, then right issue and bonus issue. Diluted EPS, as the word diluted means reduction in something. Okay. You will see that many companies issue convertible instruments like options to convert into equity shares, right? Or you are giving some warrants that allow the holders to purchase shares in the future but at a lower market price. So whenever you have an option like this, what happens? Interest of the original shareholders will be diluted. You see, if you are issuing shares in the future, whoever is the original shareholder, their interest will be diluted. They'll be having less voting power now, right? So because it dilutes their interest, it is called diluted EPS. Diluted EPS will always be less than basic EPS. Remember this. Okay. And which shares can reduce your for which shares your EPS will be diluted? Only ordinary shares. Only ordinary shares, not any other share. If you issue ordinary shares, then only your interest will get diluted. Okay. So whenever there is a dilutive potential ordinary share, that means you're issuing ordinary shares, what happens? You need to calculate two things, basic EPS as well as diluted EPS. And when calculating diluted EPS, both your profit and earnings will change. Because earnings per share is what? Earnings divided by shares, right? So your profit figure will change. That profit that you use for basic EPS calculation, you need to adjust it. How? See, because you are converting or you are issuing ordinary shares in the future, there will be so many expenses that you don't have to pay. For example, if you have converted debt into shares, earlier when it was debt, you were paying interest, you were paying preference dividend. Now you don't have to pay once it is converted to share. So you have to take it out. Coming to weighted average number of share, even this gets adjusted when you're calculating diluted EPS. How? The weighted average number of share that you use for basic EPS, okay, needs to be increased now. Needs to be changed. How? Because now, let's say your debt is now being converted to ordinary share. So now you'll be having more shares, right? So that share also needs to be there in that weighted average number of share. Needs to be added there. Examples of potential ordinary share. These are some examples how you can get that. Number one, position could be debt. Debt that is convertible into ordinary share. Second, you might be having share options. Okay, share options will give the holder the right to buy ordinary share in the future. Third, maybe you have some employee plan, okay, through which employees can get this ordinary share as a part of their remuneration, or contingently issuable shares. That means if certain conditions are met, you are going to issue shares. So in these four conditions, your EPS will be diluted. Now, this is the last part of this, assessing EPS as a performance measure. EPS can be used to measure performance. How? This is usually a discussion question, okay? You can use EPS to compare one company with another, right? Higher EPS is always better, remember. Higher EPS is always preferred. Why? Because higher EPS means you are likely to pay higher dividends per share. It's good for the investors. They can decide whether you have to hold, whether you have to buy, or whether you have to sell the shares. Third reason, okay? Many investors like EPS that are growing, because if it's declining year by year, it's a reason for you to worry, okay? Next, investors are more interested in future returns. So through EPS, they can calculate other ratios also, like PE ratio, price earning ratio. And a high PE ratio means market is confident about the future prospect. But there are some limitations to it as a performance measure. What are they? Number one, earnings are calculated using accounting policies, right? So whatever accounting policies you use, it affects your earning. You can easily manipulate your earnings. You understanding? Through your choice of accounting policies. So therefore, it may not always be appropriate to compare the EPS of different companies. Therefore, it's not easy to compare because the two companies might have two different accounting policies. Second, EPS does not take account inflation. So if you see that there is a growth in earning, it might not be true growth. You see? Third, you cannot predict anything based on EPS because maybe that high earnings that you have achieved, maybe it is at the expense of your investment. Maybe you have sacrificed your investment. Rather, if you would have invested, it would have generated increased earnings in the future, right? Then, in theory, okay, diluted EPS is like a warning to equity shareholders that their returns in the future might fall. And also, diluted EPS is based on the current earnings rather than focused earnings, you see. And EPS is a measure of profitability, right? You measure profitability through EPS, but that is not only one aspect of performance. There are so many, like your cash flow or your stewardship of assets, right? So that's it. Now we'll be doing one question before we summarize this standard. Test your understanding too. So here you are required to explain with calculations how the above event should be corrected in the consolidated financial statement. And second one is discuss the impact of these corrections on basic and diluted EPS. So even though this is IAS 33, you will be needing the knowledge of some other standards before you come to EPS for part A. Okay, there are three situations given to you and they have owned 75% shares. Co is owning 75% share in Grace. This shows that it's a subsidiary, right? Now, the first issue. On 1st of Jan 2001, 1,000 of course managers were granted 500 share option each. This will based on 31st December 2003. That is after 2 years, 2001, 2002 and 2003, after 3 years. If the managers are still employed by co, the fair value of one share option at the grant date was 6. By 31st December 2001, 50 of these managers had left the business and another 80 are expected to leave. The exercise price is 3. Average price of one of the equity share is 10. And no entries had been posted in relation to this share option scheme. This is from your IFRS 2. You need the knowledge of IFRS 2 share-based payment. I still have not done that lecture. Okay, IFRS 2 lecture will be uploaded later on. Okay, but like we'll be still doing it, we'll be still carrying this. Okay, so when we go to IFRS 2, you will be able to understand this better, right? The IFRS 2. But still, I will somehow make it briefly, I will explain you and make it easy and explain how you have to deal with IFRS 2. Okay, just a minute. The second one is it's about IAS 16. Freehold land is accounted for using the revaluation model. A revaluation has taken place in the current year. However, one plot of land is still carried in its purchase cost, that is 4, and it has been sold for 5 million. So this is about IAS 16. This we have done, so you should be able to know. Okay. And the third one is on 31st December 2001, Grace made an interest-free loan of 3 million to a charity. Okay. Made an interest-free loan of 3 million to a charity and recognized this amount as financial asset. The charity will repay the money on 31st December 2004. Market rates are 5%. Financial asset comes under which standard? IFRS 9. This also we have not done yet, but still I'll explain you briefly. Okay, and when we go in depth in IFRS 9 later on, you can always come back and watch this video to understand it better. So let us start with the first one, which is about IFRS 2, share-based payment. How do you deal with share-based payment? See, before coming to EPS, even though our main topic is earnings per share, basic and diluted, you have to know how to adjust according to the specific standard first, and then we have to calculate the EPS. Okay. Just go through the first one again, once again. Just forget about 2 and 3. They are separate, okay? You need to deal each one of them separately. They are not together. First one separate, second one different standard, third one different standard. So the first one is a share option. In share option, okay, this you have not done yet, maybe, right? If you have done it in your textbook, if you have read it, you will understand. But with me, I have not done that lecture yet because in the order, IFRS 2 comes after I finish all my IAS. I'm still in IAS 33, right? So after I finish all my IAS, then IFRS 1, 2, like that it starts. So it's a long way. But anyways, what you need to know is when there's a share-based payment, it's still better that you go through this. I'm not going in depth because we have IFRS 2 for that, but briefly I will explain you how to deal with it. Okay, when there's a share-based payment, there are two options. One, are you settling it in cash or are you settling it in share? Okay, you need to know this. Is it equity settled share-based payment or cash settled share-based payment? You first need to understand because the way you calculate the accounting is different. So through this first one, it is about shares. You're granting in shares. Nothing has been mentioned about cash. So this is, or you can say share or equity. This is an equity settled share-based payment. Okay, when it's an equity settled share-based payment, what you need to do is, okay, a remuneration expense should be recognized in P&L. Okay, expense goes to P&L. It's an expense, right? You are giving share-based payment to your employees. It's an expense for you. You need to record it in P&L, right? Over the 3 years, you are recording this expense over the 3 years because this share option is for 3 years. You need to spread it over 3 years from 2001 to 2003, right? Now, because this is an equity settled, this should be based on what? This is an option, equity settled. This should be based on these are all the rules of IFRS 2. You still don't know IFRS 2, but still I'm explaining you briefly, right? That when it's an equity settled share based payment, you need to take fair value at grant date. Fair value at grant date. Okay. If you are not like if you're not understanding it, it's fine. Just go with me. Just follow with me. Okay, you don't need to memorize anything at this stage, because anyway when we go to IFRS 2, you anyway will be coming again this over again. At that time you'll be able to understand this better when you come back to this video. Okay, but anyway, knowing it is still better, because when we go there later on, right, it will be easier for you. So this should be based on the fair value of the options at the grant date. What is the fair option at the grant date? It was, let me highlight it for you, it is $6. $6. Okay, so 6, because you need to know which fair value. When it's cash, it is not the fair value at the grant date. That's why there's a different. When it's equity, it is at the grant date fair value you have to take. Okay, so now you need to calculate the other side. You debit in P&L and you credit in equity. Okay, whereas if it's cash, you debit liability and you credit cash. Okay, now expense, you need to recognize the expense. You first need to calculate this expense. How do you calculate expense? See, in a share based payment, you start with the number of managers. First you need to calculate the total number of managers. How many managers are there? 1,000. It starts with 1,000, but you need to deduct it with the ones who are leaving. So out of this 1,000, let me highlight it for you, 50 had left, so you deduct 50. Another 80 are expected to leave, deduct this 80 also. Understanding? So it's 1,000 minus 50 minus 80, and then okay, this, then you are granted 500 share option each for each employee. This 1,000 minus 50 minus 80 are the employees. That employee you need to multiply by 500, because there are 500 share option. Then you have to multiply it with the fair value, that is 6, and you need to divide it over 3 years. Understood? So now let us do it here. So when you're taking expense here, 1,000 employees were there, 50 has already left, 80 are expected to leave before the vesting period. Multiply by 500, because there are 500 share options. These are employees, okay, 1,000 and 50 and 80. Multiply by 6 the fair value, and you need to multiply by 1 over 3. You need to divide it over 3 years. You need to spread it over 3 years. So it will be 0.9 million. How do you adjust this entry? You need to debit in P&L, because it is an expense, and you need to credit in equity. This is the journal entry. Okay, so what happens to your earnings? Please understand, our main focus is on EPS. Okay, we are doing A and B together. Our main focus is on EPS. What is happening to our earnings? What is happening to our shares? What is happening to our profit? So if you see this adjustment, you see there is an expense of 0.9. So it reduces your profit, isn't it? Your earnings are reduced. Your earnings, it will reduce your earnings by 0.9. So if it reduces your earnings goes down by 0.9 million, what happens to your EPS? Tell me. Just have an idea. If your earnings reduces, your earnings per share, both basic and diluted, will also go down. Will also go down. Understood? You just need to explain that. You don't have to actually calculate. Okay? How do you know? Okay. Basic we understood. Now tell me how diluted. Because some share options do not dilute, but here it is diluting. How? See, this is a share option. What is it? It's a share option. That means in the future you are given the option to buy the shares at a lower price, below the average share price, right? That means it will reduce the interest of their shareholders, existing shareholders. That's why your diluted EPS will go down. Understood? So that's about share option. Now we are moving on to the next, that is part B. Part A is over. This one is over. 2 is LAN, right? IAS 16. This you should be knowing, right? But IAS 16 says, in IAS 16 there is one more standard. Here they told that it is revaluation model is used. If a revaluation model is used, you have to use IFRS 13, fair value measurement, this standard. Okay. So IFRS 13 has, when we go to IFRS 13, this is not the answer, but I'm just telling you. I'm not writing the answer. The answers are there, nicely written. You can go take your own time and read it. It's there in your textbook. Okay. What I'm saying is I'm breaking down the answers for you. How do you arrive to that answer that is given to you? That is my aim. So IFRS 13 has 3 levels, right? Level 1, level 2, level 3 of measuring fair value. Level 1 is the most easiest because you can easily observe it. Like for listed company, the share price and all. For 2, you compare it with something similar. And level 3 it is the hardest. You need to predict using cash flow forecast or something. It is not very observable and it's very risky to be in level 3. Always level 1 is preferred. If level 1 is not, if you are not getting the price through level 1, you have to use level 2. If you are still not getting it, then level 3 is the last resort. So let's see, you need to understand in this question, at what level is it? Is it level 1, level 2, level 3? For that you need to read again. Okay, revaluation takes place in the current. However, one plot of land is still carried in their financial statement at its purchase cost, and similar plots of land has been sold for 5 million. On 30, okay. So tell me, is it level 1, level 2, or level 3? It looks like it is level 1. Why? The word similar. They didn't say exactly same price or exactly the same land. They told similar plots of land. So it looks like it's at level 2. Okay, it's a level 2. It is at level 2. So now, in level 2, you have to make adjustments. In level 1, you take the price as it is. But in level 2, you need to make adjustments. And level 3 also. Okay. So, see, to make any adjustment, okay, it's always good to make adjustments. How do you make adjustment? You have to see whether you have to make adjustment for this 5 million. What is it? This 5 million. It has been sold for 5 million. But what adjustments you need to make? You have to see your location, right? Similar plots of land 5 million, okay. But you have to see your location and condition of that asset. Okay. So let's see in this case, okay, let's assume no adjustments are required. Okay. So the land should be revalued to its fair value of 5 million. But see, in generally, okay, you have to make adjustments. But since there are no other information given to you to make adjustments, they didn't say what is the condition of your land, they didn't say what is the condition of your asset. Okay, they didn't say all those things. They already gave you for similar it is 5 million. Okay, so that's why you are not in a condition to make an adjustment, but in really you have to make adjustment. But for this question, let's assume no adjustments are required. So you take this 5 million as fair value. Understood? So that means the land should be revalued to its fair value at 5 million. Okay, you see, you have bought it at 4, you are selling it at 5, you are having a profit of 1 million. 1 million is a profit. Where does this profit go? Please understand this. Where does this profit go? OCI, other comprehensive income. Why? Remember, IAS 16 rule says any revaluation gain goes to OCI. In case you forgot IAS 16, please go back to my IAS 16 lecture and see this. Where does the revaluation gain goes under IAS 16? It goes to other comprehensive income. Right? Now, so you debit property, plant and equipment because value will go up, and you credit other comprehensive income by 1 million and 1 million. Now tell me what happens to the earnings. Will this have an impact on your profit? because it's earnings per share. Earnings means profit only. If anything happens to profit only, your EPS will change. But see, this profit that goes to other comprehensive income are not reclassified. In case you forgot, you need to go back to IAS 16. There will always be an OCI. They are not reclassified to P&L. That means this will not have an impact in your earnings per share, both basic and diluted. Because it is not having an impact on your earnings. It will remain in other comprehensive income only. Therefore, your basic and diluted EPS also, it will not have any impact. Moving to the third, C, financial asset. Okay. Tell me. You first need to understand also whether it's a financial asset or not. They have given a interest-free loan to a charity. Understand the nature of this interest-free loan. What type is it? Is it a financial or non-financial? First understand that it's a financial asset. Why? Because it gives grace. It gives grace the right to receive cash. If you are giving an interest-free loan to someone, aren't you receiving cash from them? You are, right? So you have a right to receive the cash. That's why it's a financial asset. First, you need to understand whether it's correct to recognize it as a financial asset or not. Then only comes IFRS 9 and all. So in this case, yes, it is right. It is a financial asset because it gives contractual right to receive the cash. Okay. Now, once you know it's a financial asset, okay, still we have not arrived to IFRS 9. Okay, but let me tell you, when we go to IFRS 9, in depth, I will go through all the financial asset, financial liability, everything. But for now, in short, just know that financial asset initially are measured at fair value. Okay, fair value. Initially. Subsequent measurement and all, let's not go to it right now. But for this question, it is initially measured at fair value. So because the interest-free loan, okay, the loan is interest-free. The 3 million price does not represent the asset's fair value, this 3 million. It does not represent the fair value because it's an interest-free loan. I mean, see, when you go to the market, can you get the price for an interest-free loan? It is up to you. It's interest-free. If it was interest loan with interest, you can easily compare it with other loans and get the fair value in the market. So for this, you cannot get the fair value easily. Interest-free loan is not something which is very similar. It is not there in the open market for which you will get a price. Therefore, the 3 million does not represent the asset's fair value. So, but still you have to get the fair value. How? How? The level 3. Level 3. Level 3 says discount the cash flow. Discount the future cash flow to the present value. That you can do, right? So you have been given 3 million. Okay. This is the cash flow. You have been given the market rate of interest, that is 5% over for 3 years, because starting from 2001 to December 2004 for 3 years. So when you discount it, it will be 3 million into 1 divided by 1.05 because it's a 5% to the power 3. This is how you find the present value of the future cash flow. That will be 2.6 million. You see? That means financial asset, you have recognized it earlier as 3 million. Now it is 2.6. It went down. It went down from 3 to 2.6. So what happens? From 3 to 2.6, it goes down. What happened? There is a loss of, it's a financial asset. See the nature, asset value go down is not good for you. It's a loss of 0.4, the difference. So this will be recognized where? In P&L. Correct. In P&L, it will be recognized as a loss. Debit P&L 0.4, credit financial asset 0.4. So debit, it's a loss. Your earnings will go down, isn't it? So your earnings goes down means what? And wait a minute. This is for consolidation purpose, right? Just all this while, okay, the first and the second, the nature of the first and the second is different compared to third. Why? In the first and the second, it has to do with the parent. But in the third one, they are giving this interest-free loan, okay? Craze made an interest-free loan of 3 million to a charity and recognize this amount as this one. This is about a subsidiary. Craze is the subsidiary here. Subsidiary is making this, okay? And co-owns 75% in subsidiary. So when you're doing it in the consolidated financial statement of the subsidiary, okay, you only have to take the 75% of it. When you're consolidating, only 75% of that you have to take of the subsidiary. But in the first and the second, you see it has nothing to do with Craze. You understanding? It only has to do with the parent. That's why we didn't have to take the 75%. Entirely 100% we took. Last one, Craze is giving this loan. So it has to do with the subsidiary. That's why only 75% of that loss you can take. You understanding? The parent's interest, the parent's loss. So when you're taking this 0.4, entirely 0.4 you cannot recognize. You have to take 75% of that 0.4 in the consolidated financial statement, which will be equal to 0.3, up to this much. Okay, this 0.3 is attributable to parent, 0.1 is to the NCI. We are focused on the parent part. So this reduces your earnings, basic and diluted EPS both will go down. Right? That's it. So now we'll be summarizing IAS 33. Now some key points that you need to remember about IAS 33 are scope, only for listed companies. Basic EPS, remember the formula. Bonus issue, basic EPS formula, what is it? Earnings divided by price, right? That means your profit divided by your weighted average number of shares, right? Then we have bonus issue. For bonus issue, it reduces your EPS, and remember the bonus fraction. There's a bonus fraction, you need to remember the formula. Right issue also you need to remember, but you need to adjust it. You need to adjust that bonus fraction for the right issue. Remember the formulas. Diluted EPS will always be less than basic EPS, and in diluted EPS, your earnings as well as shares both changes. And finally, using EPS to assess performance. Always higher EPS is preferred over the lower EPS. Okay, because it's good. It shows that there's a good indication of higher future profitability. And through EPS, you can calculate other ratios like price earning ratio. But remember, with the advantages comes some limitations also. Okay, you are using EPS to measure the performance, but it also has some limitations that you need to remember. We went through the list of the limitations, right? It's an accounting measure, it could be manipulated, you cannot compare the two companies using different accounting policies and like that. So that's it for IAS 33. We'll be seeing you in the next standard, which is IAS 34. It's a very short standard. And thank you for watching, and do not forget to subscribe to my channel if you haven't subscribed yet. Thank you and take care.